Depot. Well, let's get the portfolio rising, no matter what's moving. Jamie Cox is managing partner at Harris Financial Group, and Tom Lydon is president of Global Trends Investment. Tom, I'll start with you. You were bullish precisely at the right time, and you remain so. I'm very interested to know where you stand now as we start to hit these markers.
Well, it's a great day today, Liz, and I look back on 10 years ago when the first time the Dow went above 10,000, I had a full head of hair. But now
I want to see that.
we're encouraged because those that were looking for a correction in September and October missed out, and there's still $4 trillion on the sidelines. Hopefully, by going above 10,000 again, those investors that need a little bit of a psychological push will start moving in, because hopefully the next 10 years will be much better than the last.
Tom, do us a favor. Next time it hits a milestone, bring an afro wig and put it on. We'd love to see you with one of those. All right. Let me go over to Jamie if I can, because, Jamie, you are right on the money to what's happening today. You suggested, you wrote in your notes before everything popped, that financials should be looked at very carefully. You look at all the financials today, they're doing terrific. Is this sustainable?
I think it is. First of all, if the next 10 years Dow hits 10,000, 10 years from now, I'm going to be in the same predicament as Tom. I think it does it to you if you end 10 years, have a flat market in 10 years. I think it's bad for your hair. But otherwise, you know, you think about these large cap financials, JP Morgan, Bank of America, and others, the unbelievable earnings power that these companies have. Take, for example, JP Morgan. On the conference call today, was talking about loan loss reserves being reduced down to $2 billion. At some point in the future, the loan loss reserves are actually going to turn over, and they're not going to be reserving. They're actually going to be lowering those reserves, which is going to be enormous for earnings power in the future. In addition, investment banking revenues are also, you know, normalizing things to offset some of this consumer problem that they have in the short run. So I think if you are looking for, if you think about where the prices of these securities are, particularly at the low end, like Bank of America and the non-TARP banks like JP Morgan, they still have a long way to go. I mean, we're looking at probably dividends to be replaced on those stocks. I mean, there's so many things that can go right in the future that I think that those are stocks you can own.
Okay. Now, Tom, let me not throw ice cold water on the party here, but I want to be cautious for our viewer investors, because I think it's important that we talk about the headwinds that are out there. What worries you right now?
Well, inflation. And, you know, I think what we have to do is investors have to consider commodities as an asset class, and really up to this point they haven't. But today, with the ease of investing in ETFs that cover all areas of commodities, it's very easy to protect against the declining dollar, potential inflation, and with a boom that we're seeing in emerging markets, there's a huge demand for gold, oil, and a whole variety of commodities.
Well, of course, the key is, Jamie, how you divide your portfolio to protect it. That is, do you put 40% of it in these safe bets, assuming that inflation is going to come in, or do you miss out on other bets by putting so much in?
Well, if you're talking about allocation, I think for the most part, investors have been hiding out in investment grade and high yield bonds for the majority of the year. You can see it in the mutual fund flow data, you know, record inflows into investment grade and high yield bond funds. And I think that, you know, that party is over. So I think people are, particularly retail investors, are overweight those type of sectors, and they need to come back to be equal weight, to get out of those bond funds that they've been hiding out in and go more back to the equities that they came from, utilities, telecom, others that have similar yields but can get you back in the equity market, you know, to walk back in. So I think
I couldn't agree more, Jamie. And again, moving away from fixed income, we're going to see higher rates down the road, but you've got to start shifting equity positions more overseas, and you have to pick your spots and making sure you have a greater percentage in these commodities
Jamie
areas.
Cox, Tom Lydon. Tom, next time you're here, we want to show what your hair looked like at Dow 10,000 the first time around.
We'll buy you a wig.
Thank you so much. Good to see you.